All right, let's get started. Uh, so I wanted to just point out one thing that I've created a new folder called class recordings. And so I've been recording the classes. It takes a requirement that we record these classes and then post them. But I do that in all the classes I teach in any case. And so if you want to go back and look at any particular class, then you'll be able to find that here. So today I want to continue our conversation around the week 2 agenda. So I think I'm going to move on to chapter 3. And just as an FYI, probably tomorrow I'll post the first quiz. The first quiz will be on chapters 1 and 2 and Enron. And I'll talk about it a little bit more on Friday when we get back together. So the way I usually do quizzes is I usually set them up in a separate folder and give you a few days to go through and do them. So the quizzes will be ones that you can open up just once and you'll have to complete it. It'll probably be about 15 to 20 objective questions. Most of the questions that I ask will be from the Kahoot exercises that I have you do during our session. So all the lecture slides. So nothing tricky. Everything should be straightforward. You know, again, my goal with quizzes and testing is just to reaffirm that everything is being communicated and understood as it seems to be. So.
Is the quizzes timed?
So I haven't made up the first quiz yet, but probably not. I usually don't time quizzes, so I don't think I will on this one either. And obviously it's open book and open notes since everybody's remote, but you know, my approach on quizzes anyway, even when I'm in a classroom, is I always allow open book and open notes. So just my basic philosophy on quizzes is to really just to reaffirm that things are moving in the direction that I expect. So.
And when is the second discussion board thing due?
I'm sorry, Zola, could you ask that again?
When is the second discussion board due?
Oh, okay. So I should put a note there. The discussion board questions, I'd like you to finish them by Sunday, before the start of the next week. Okay, so I also I created the third week 3, and I just want to point out something to you for week 3. So in week 3, the discussion board is going to be about audit reports, which is what we're going to start to talk about today. So we'll talk about audit reports today and a little bit more on Friday. And then the part of closing out the learning on that is I posted some materials here on understanding audit reports, and I ask you to find an audit report and then to answer these basic questions. And I'm going to go through the different elements of an audit report today and on Friday. So I just want to give you a heads up that that's week 3's discussion question. So you don't even need to think about that till next week, but just as a heads up as we start to think about audit reports. Okay, so let me just find my slides here. So the audit report is, you know, an integral product that CPA or independent auditors provide, and the focus in our discussion is going to be on the audit report that the CPA provides to publicly traded companies. And there's really, there's two types of audit reports now. It used to be one, but since Sarbanes-Oxley, there's been a second type of audit report that's been introduced, and that's for companies that are required to comply with Sarbanes-Oxley. Then the CPA also has to attest to that as well. But today we're going to just focus on the financial audit and the financial audit report. So every publicly traded company is going to have an audit report in their 10K. So look, let me just quickly show you something. So I'm going to go to Apple, the Apple 10K. So most publicly traded companies, if you go to their website, are going to have a section called Investors, and in there are going to be their filings with the Securities Exchange Commission. So I'm going to look at their annual report, which is also called the 10K. So the last one that Apple filed was October 30th. So let's open up their annual report. And if you haven't looked at a 10K before, what I want to, I'm going to point out a couple of things. All publicly traded companies are required to file their 10Ks, which is their annual report with the Securities Exchange Commission. They're also required to file 10Qs on a quarterly basis. But we're going to just focus on the 10Ks because the 10Ks will have the audit report and the auditor's opinion. So you can go to any publicly traded company, go to their website, or Google the 10K, and you're going to find that there's a standard format that 10Ks follow. And we're not going to focus on 10Ks in this course, but in there you're going to find the audit opinion. So I just have to figure out. I believe it'll be at the end of the financial section, which is item 8. So let's just take a quick look there. Okay, so they've got two audit reports here, as I mentioned, because Apple is required to comply with Sarbanes-Oxley. We're going to focus on the financial report. So you'll be able to find the report of the independent public accounting firm on any 10K. You'll find it at the end of their financial section, which is section 8 in the 10K. And in here, you're going to see a fairly standard format in terms of audit reports. And it'll be signed by the audit firm. So Apple has Ernst & Young, and they'll have the date that the last date of their audit work. And so essentially, for any publicly traded company, in their 10K, you'll be able to find the audit report. Okay, so we'll come back and look at this again. And if they're required to comply with Sarbanes-Oxley, and we'll talk about this more on Friday, they may also have a second audit report that deals with their internal controls. And their internal controls is really compliance with Sarbanes-Oxley. Okay, so just want to point that out at the beginning. And then when we look at the audit report, there's some things that come into play. Okay, so there are standard sections in the audit report. Then there are different types of audit opinions that a CPA firm can render. They can render unqualified, a qualified. They can render an adverse, or they can disclaim. Okay, so there's basically 4 categories that you're going to find. The one that is most often provided to publicly traded companies is the unqualified. So that is always the most desired by companies, and because basically what an unqualified report says is that there are no material misstatements in the financial statements as prepared by management, and management has complied with GAAP, and so there's no major problems, and so as a result, investors and creditors can rely upon it. And then it goes kind of downhill from there. So sometimes it's a qualified opinion, and generally speaking, qualified opinions are not going to, are going to address a certain issue where there might have been a disagreement. And then they might, if they get too adverse, then that's a serious problem. If a company has an adverse opinion from a CPA, they're in deep, deep trouble. Investors and creditors will run away from that company as quickly as possible. So, so let's just kind of keep that in mind as we go forward. And we'll look at the different components of when each of these applies. So first is describe the standard parts of an unqualified audit report. Okay, so what we're going to find for an unqualified audit report, and this is going to be standard, is the report title. And basically, it's going to we're going to find the audit, who the audit report is addressed to. We'll find an introductory paragraph that basically talks about the management responsibility and the audit's responsibility. Then we'll find the opinion paragraph, and then we'll find the name and the address of the CPA firm and the audit report date. So it's very brief. It's usually 1 page, unless there's some issues going on, but it's usually 1 page and generally follows the standard format. So I'll show you an example of one, if I can make this a little bit bigger. So let me just use this. Okay, so it always indicates independent audit, right? And then you notice it's to the stockholders and might be to the board of directors. So here's the report title, independent auditor's report. Here's who it's addressed to. Here's the introductory paragraph. It basically says what was audited. So we've audited the accompanying balance sheet of the General Ring Corporation as of December and the related statements of income, a change in stockholders' equity, and cash flow. So basically, to have an unqualified report, all 4 financial statements have to be there. The income statement, the balance sheet, statement of shareholders' equity, and statement of cash flow. And the audit firm will say that they've reviewed all of them. And then they'll talk about management's responsibility for the financial statement. So I'm sure you know that the responsibility for financial statements resides with management, not with the CPA firm. In fact, a CPA firm who comes in and issues an audit opinion cannot prepare the financial reports. Right? So, and so there has to be a clear distinction and separation of duties here, that the management is responsible for preparing them, they're responsible for the content. The auditor's responsibility is to express an opinion on the financial statements based on their audit. So they'll say, we've conducted our audits in accordance with auditing standards. Okay, we'll get to that in a couple of weeks, what auditing standards are. So sometimes there's an acronym used, GAS, Generally Accepted Auditing Standards. In the United States, those standards require that we plan and perform the audit to obtain reasonable assurance. Okay, that's the key word here. Reasonable assurance, not absolute assurance, about whether financial statements are free of material misstatements. And then they'll go on to talk a little bit more detail about the scope, and then they'll render their opinion. So in our opinion, the financial statements referred to above present fairly in all material aspects, the financial position of the company, as of these particular dates, and the results of operations, blah, blah, blah. And so this is basically, and then they'll sign it, name of the CPA firm, and the last date that the field work was completed. And so that's basically what you're going to find in an unqualified report. Now, if there's qualifications, if there's an adverse situation, then there'll be some modifications to this report. But this is essentially the approach that that you're going to see in an audit report. And so this is the third party attestation and review of the financial reports as prepared by management. This is the report that the CPA firm provides and is encompassed in the annual report. Okay, let me. Okay, so any questions on that?
Why is it called unqualified again?
Okay, so it's it's interesting because when you think about something that's unqualified, generally you think about it's not fit or not ready to do something. But when it's used in auditing terms, it means that there's no qualifications that the auditors have to the financial statements. And so I know it's kind of funny wording, but so if there's something that the audit firm disagrees with, they'll qualify their opinion. And if they have serious disagreements with them, they'll issue an adverse opinion. So that's just the terminology that was selected, whenever these reports first got issued, many decades ago. Okay, so just think about when it comes to CPA, when it comes to audit opinions, what you want is an unqualified, which means there are no qualifications to the opinion. All right, does that make sense? Is that okay?
Yeah, thank you.
Sure. Thanks for the question.
Wait, so basically when it's unqualified, that means that they don't disagree with anything and that it's all set, essentially?
Essentially, yeah. That's what every company wants, is an unqualified opinion from the CPA firm. It's the highest level of an audit opinion that a company can get. And it basically means that the auditors didn't find anything material that they're concerned about, so that we as investors and creditors can rely upon the financial statements. Other questions? Okay, so I'm going to open up Kahoot. We're going to go through a few questions here. So we'll spend today and Friday on audit reports. Okay, so we're going to go through really in two sessions. The first, we're going to look at some of the key financial aspects of audit reports. Then on Friday, we'll continue that and start to look at the Sarbanes-Oxley report. Financial statements are so materially misstated they do not present fairly the entity's financial position. What would you expect in terms of an opinion by the auditor? Yeah, most likely you'd get an adverse opinion. If there's so material misstated that they do not present fairly, and that's a death knell for an organization. Because what happens typically in an audit is this: the CPA firm comes in. We hope that they're independent and they're thorough in their audit work. And I've seen many times where the CPA firm will find things that they don't agree with. So typically what happens is there's negotiations between management and the CPA firm, and management typically will fix whatever concerns the CPA firm has, if at all possible. But if they can't fix it or they disagree, then it's either going to be qualified, or the worst case is that it's going to be an adverse opinion. An adverse opinion basically says that the CPA firm does not believe that the financial reports as prepared by management fairly represent the situation. And that's, as I said, something that really is disastrous for a publicly traded company. Doesn't happen that often. To emphasize the fact the auditor is independent, a typical addressee of the audit report should not be who? Okay, good, yeah. So should not be the company controller, because the CPA firm is really auditing the work of management, and the company controller is a big part of senior management. So the report is for and addressed to either the board of directors and or the shareholders. So as I'm sure you know, shareholders own publicly traded companies, and they appoint the board of directors, who then appoint senior management. The standard unmodified opinion audit report states the audit is designed to do what? Yeah, provide reasonable assurance that the statements are free of material misstatements. So just keep those two words in mind, because they are, they're a little nuanced, but I'm going to give you reasonable assurance, not absolute assurance. And that I'm not saying there's no mistakes or misstatements, but I didn't find any material or significant misstatements. No material misstatements and compliance with GAAP, generally accepted accounting principles. What type of an opinion would you expect to get? Yeah, so generally speaking, these are components of an unqualified, which is the highest ranking of audit reports. So, and certainly to get an unqualified opinion, you need to, both of these have to occur. The auditor has to feel as though there are no material misstatements, and we have to comply with generally accepted accounting principles. So we're going to just go through some of the different parts of the unqualified audit report. So here they are: report title, who the audit report is addressed to, the introductory paragraph, management and auditor's responsibilities, the opinion paragraph, then the name and address. So we looked at that briefly. Let's just do a couple of questions. Title should include the word what? So please type your answer. Yeah, it should include the word independent, right? We want to make sure that that it's clear that we're in. So by independent means that I'm independent from management, that I'm brought in really as a check and a balance, and the certified public accountant, the CPA, and their audit function is an integral part to our financial and accounting system. You know, people will not be willing to invest or loan money to companies if they didn't have some third-party review by a professional, competent person who's able to understand financial results, knows how to do audits, right? So this is a critical matter to the functioning of our economy. Okay, so the next one we're going to look at is who the audit report's addressed to. Yeah, so either or both. So typically it'll say, you know, one or both. But you know, clearly it's it's to provide assurance to people who are in charge, who either own the company or who are in charge of hiring the senior management team, that that's who this report is for. So let's look at some of the other nuances in the report. The introduction paragraph does three things except what? Yeah, so it states that an audit has been done, lists the financial statements that were audited, and then defines the responsibility between management. So let me just go back and put this up again. Okay. So the introductory paragraphs, right, does not provide an opinion, but it's going to talk about those other things. Responsibilities distinguished, right? What work was done. So okay, so let's keep going on this vein. So we've talked about the parts of the standard unqualified report. Management is responsible for the preparation and content of the financial statements. Okay, good. Yeah. So that needs to be clearly understood by everybody. The CPA firm does not prepare and is not responsible for the content. That's management who owns that, right? And is liable if there are material misstatements. Now, the CPA firm might also be held liable as well if they were negligent in reviewing the reports, but their job is to use professional protocols and procedures to conduct an audit. The most desirable or best audit opinion is what? Yeah, so as funny as that word seems, that's what the professional industry calls it. It's the unqualified opinion. That means I have no major qualifications to the report. So a condition for a standard unqualified audit report, we have to have all the financial statements. So there are 4 key financial statements: income statement, balance sheet, statement of cash flow, and statement of shareholders' equity. Those have to be present, and those have to have been reviewed by the audit firm. And then there has to be sufficient appropriate evidence. Okay, so we'll talk a little bit more about that as we move into audit procedures, but essentially, the CPA firm has to have looked at all significant accounts and made sure that they have enough evidence to verify that what management has prepared is accurate. So when they look at the inventory account, they have to have gone out and done at least a valid statistical sample of the inventory to make sure that it's accurate. Same with sales and so forth. So they have to go through all the key accounts. It doesn't mean that they look at everything, but when we talk about significance, we're talking about things that might influence the decision-making of investors and creditors. So if there's an account out there that is a small amount, they may not spend any time on it. But if it's significant, they're gonna have to make sure that they've done some review and can validate that the numbers are accurate. And then that management has to comply with general accepted accounting principles in the US, right? So, and again, that requires competence and expertise. I'm sorry, hold on one second. I'm waiting for a delivery here. Sorry, I'm gonna put this on mute. Yeah, I'm sorry about that. I'm at home and I hired a company to come in and move something for me, and I thought that might be them, but it wasn't. So, okay, so and then there are no circumstances that require an explanatory paragraph or report modification. So when that happens, what's going to happen is that we'll have what's called a qualified opinion. So a qualified opinion is not disastrous. It depends on why the CPA firm wants to explain something. So many times investors and creditors will look at it and say, okay, that's understandable as to why you need to explain that, or why there's a difference between management and the CPA firm. We can live with that. So the 4 categories of audit reports. So what we hope for is the unqualified report. So the four conditions that we just stated have been met, right? And so a complete audit took place with satisfactory results and financial statements that are fairly presented. But the auditor believes it's important or is required to provide additional information. So that's unqualified with emphasis of matter. So not quite as good as a clean unqualified, but one that investors and creditors can say, okay, not a big deal typically. But it does alert investors and creditors that maybe something is there that we need to take a closer look at. Then a qualified report, the auditor concludes the overall financial statements are fairly presented, but the scope of the audit has been materially restricted is one possibility, or applicable accounting standards were not followed in preparing the financial statements. So when we say they weren't followed, they may be, one of the things about accounting standards is their principles, they're not rules. And when we have principles, there are often different ways of interpreting them. So many times when you see a qualified report of this nature, then management is interpreting the accounting principles to say to be applied one way, and the CPA firm does not necessarily agree with them. And so when they do that, what they'll say is that had the management agreed with our approach, then the income statement would have reflected this difference, and the balance sheet would have reflected that difference, and so forth. So they'll articulate what the differences are. Again, that's a little more serious, and that will certainly get investors and creditors' attention. But generally speaking, it's not going to be a showstopper, particularly if management is on firm footing. So those are, and then the third and fourth kind. The third kind is adverse, and that is something that no management team can survive. If you get an adverse opinion from your CPA firm, then you're on your way out, and your company, so senior management is going to be replaced in all likelihood, and the company may not survive it either. But basically, what they're saying is that you have not prepared financial statements that are reflective of your results. So either you haven't followed general accepted accounting principles, or what you've stated is just not factual. Again, disastrous. You don't see that happen very often, but but certainly it does happen on occasion. What's more likely to happen if is that the auditors may disclaim an opinion, and they'll disclaim an opinion not if they find that management, if they have evidence that management does not comply with GAAP or there are material misstatements, they're required to provide an adverse opinion. So what happens more often when there's something going on is the auditors will disclaim an opinion. They'll say that the scope of their work was restricted in a manner they can't provide an opinion. And that's not as bad as an adverse opinion, but that is not something that provides a lot of confidence to investors and creditors, and certainly not something that any management team wants, right? So management team to thrive and to keep the confidence of investors and creditors, that they want, ideally they get a standard unqualified or at minimum an unqualified with emphasis. They can probably survive a qualified opinion, particularly if it's over some legitimate dispute. But if they get an adverse, then they're basically done. And if there's a disclaimer, that's going to set off alarms that something's going on here. Management preventing the CPA firm from doing their work typically. And if they're doing that, then there's got to be something more serious going on here that we're concerned about. So those are the four types of reports that that we talk about the financial aspect. Okay, so we're going to pick up at this point on Friday. We'll talk about where it's appropriate that firms have to comply with Section 404 of Sarbanes-Oxley, and this is the internal control reports that I showed you briefly on the Apple 10K. Not every company; it's really just the larger publicly traded companies that deal with Section 404 of Sarbanes-Oxley. So originally, when Sarbanes-Oxley was passed back in 2001 or 2002, the thinking was all publicly traded companies would have to comply. But due to the amount of investment that was required to comply with Sarbanes-Oxley, the regulators backed off, and essentially it's just larger companies. Okay. So I think that's everything for today, unless there are any questions. Oh, there's my call again. Okay, thank you. Hello. Hello.
This is Nestor from Animals.
Hold on one second. I'm sorry, it's who?
minimal.